How are bond prices related to the stock market? There are many asset classes that are traded in the financial market, such as bonds, equities, commodities, and more. However, it may or may not be necessary for every asset to move in sync with the other one. For example, gold prices generally tend to move in the opposite direction of equity prices, and gold is considered as a safe haven asset. So, whenever there is uncertainty or pessimism in the stock market, investors tend to switch to the safer assets such as gold. And similarly, investors also make a choice to shuffle their portfolio holdings between bonds and equities. An ideal portfolio has a judicious mix of both, and the ratio of this asset allocation has a vast impact on the portfolio's performance. Relationship of bond prices with the equity market. Generally speaking, the bond market is inversely proportional to the stock market. In simple words, when the equity prices fall, the bonds prices tend to go up, and vice versa. In a booming economy wherein consumer spending is on a rise, interest rates are set at a comfortably low level. Companies are clocking higher earnings and more. Equity prices move upwards as investors feel confident. To look at it in another way, when investors see an opportunity for high capital growth in equities, they pull out their investments from a relatively safer asset, bond, to invest in equities. And this affects bonds prices and they decline. In an opposite scenario, when the economy decelerates its growth due to subdued consumer spending, leading to a downtick in corporate profits, investors feel more confident with the regular interest payments from the bond market. And this leads them to liquidate their equity holdings and channelise those proceeds to investing in bonds. Hence, equity prices decline and bonds go up in value. However, this interrelationship is not steadfast. Although uncommon, both bonds and equities can fall or rise at the same time as well. For example, when there is excess liquidity in financial markets, generally pumped by central banks, both assets could see an uptick in prices. Similarly, when there is extreme pessimism, so much that investors get sceptical about the government's ability to service its debt obligations, both assets can see a fall in tandem. Can the bond market be a useful indicator for equity investors? One thing is clear by now, both the markets generally move in the opposite direction. Therefore, an investor can gauge the movement of one market and forecast the movement of the other. To gauge the movement of bonds, one has to understand how they react to interest rates. Bonds also have an inverse relationship with interest rates. When interest rates rise, the price of bonds fall, and vice versa. In other words, when interest rates go up, investors try to get out of existing bonds as the interest would fall short of what new bonds would offer due to the higher interest rate. Hence, bonds fall. And likewise, if interest rates fall, investors flock to buy existing bonds as their returns would be higher than the upcoming bonds due to lesser interest rates. And this way, bonds can also help investors gauge periods of high interest rates, which can help them make informed decisions in the equity market. For example, sectors such as real estate witness some selling pressure, and investors can expect some correction in other sectors. If you like this information, let us know by liking, sharing, commenting on the video below, and subscribe to the channel. If you press the bell icon, you'll be notified of the latest videos from Kalkine. For more articles like this, head to the website kalkinemedia.com. I'm Sage for Kalkine Media.